We're gonna record. Yeah, Rob, I'm sorry. Rob, are we good? Are you good to go?
Yeah. Go ahead and mute your. Okay, perfect. Good afternoon. This is Rob Daniel, RVP with Securian, along with Mike Swayze. So really appreciate the time today, and hope everyone's having a great week. So yeah, logistically, this is one of our first presentations. We're actually in the office together, especially with Lewis. So it's a great opportunity. We've been working with Lewis quite a while, and really thank you for your business at Securian, and thank you for your support. What we want to do today is offer you some ideas for 2024, where we're finding cases. And specifically, we are seeing a lot in the permanent life insurance space with chronic illness solutions. We do see a lot of cases and a lot of talk around the sunset provisions, so we might go through that a little bit in this presentation as well. If there's any questions, please let us know. We'll be going through some case studies as well, and also a way to find some of these cases. I think as you go through these concepts, it's not only learning the concept, learning a product choice and a design for it, but it's also where to find them from a marketing standpoint. So we're going to try to accomplish that all in one session here. So I'm going to go ahead and share my screen. And bear with me just a second. And so everyone should see our presentation today, Planning for Every Life Stage. It's going to be an in-depth look of long-term care and chronic illness planning using life insurance solutions, maybe as an alternative to individual long-term care. And talking to Lewis and looking at opportunities for 2024, we see a big opportunity with permanent insurance, whether it is an individual policy with a chronic illness rider or whether it's a linked benefit solution. And that's what both of us handle with Securian. So I am the individual or the RVP for individual life insurance. Mike Swayze is the RVP with Securian for the linked benefit solution. So in looking at the market right now, so these are, we want to throw out some demographics of what we're seeing in the marketplace. So you see the different generations, the millennials, Generation X, baby boomers, and then the silent generation, greatest generation. I want to circle on the baby boomers. And currently, basically, you're talking about ages late 50s to mid 70s. 70.4 million people are in that demographic. And if you've seen a long-term care presentation, you know that this is the graphic. This is where we're concentrating a lot of our marketing towards. 10,000 people a day in the baby boom generation is turning 65, which is amazing. 60% of Americans are actually turning 65. So this is right in the wheelhouse of where we are seeing cases and seeing opportunities, is really targeting that baby boom generation. Now, we are seeing solutions in younger generations, the millennials, the Generation X, especially in locking in insurability, and we have an idea for you with that as well today. So definitely take a look at your client base and look at your market. And especially with the cost of what long-term care is, we're seeing cost rise every year. And that's why you see inflation riders on long-term care coverage. So if you look at the screen, it says, if a client at age current, as an example, 55, if they wait 10 years to apply for long-term care coverage, whether that's individual or whether that's a life insurance solution, on average, they're going to pay almost 50% more for their coverage if they wait 10 years. And I think that's just, it's an amazing stat. And if you look at kind of where costs are and pricing right now with insurance policies, as I've talked to Lewis, when you look at especially individual life insurance coverage, especially with a no lapse guarantee, the pricing on those policies are fantastic right now. It's the best they'll probably ever be. And you're probably not going to see any rate changes for 2024, but you cannot guarantee that for 2025. We do expect rate changes, whether it's the individual life market or whether it's the long-term care market. So if there was a time to do this, right now is the time to be able to take advantage of those opportunities, especially with no lapse pricing and pricing for long-term care. So when you look at the different options, this is a graph that basically shows you from a coverage standpoint, which type of solutions has the most comprehensive coverage. So there are people who choose to self-insure, and obviously that's the lowest amount of coverage because you're paying for it yourself. all the way up to traditional long-term care. And we're going to concentrate in the middle here because a lot of advisors are figured out with the issues of individual long-term care, with the price increases that you see with those, that annuities, life insurance with an acceleration rider, the hybrid products, they're great solutions and they are priced very well right now. So I always look at this with coverage, and as we talk, both myself and Mike talk about long-term care, I know personally when I make presentations like this, I always talk about, if you were looking at long-term care, a lot of times if you've gone through the process yourself with a family member, it hits home a little bit more. And I don't know, for those in the audience that has ever dealt with a family member who needs long-term care coverage. I personally am dealing with that with my mother and father. Just moved them into an assisted living facility. They're in their mid to upper 80s with lots of health issues. And I could tell you, the more comprehensive coverage, I wish we had it. My father and mother who weren't in the best health over the last several years are doing the self-insurance route, and to take qualified money to pay for these expenses with how much it costs now is a tremendous burden. And when you look at the cost today of what it takes to be in some of these facilities, a average nice facility on assisted living is running, I know in North Carolina where I'm from, about $12,000 a month. And if you look at that, that sounds expensive, but if you look at what they're getting with how much it costs to run these facilities, it's actually a pretty good deal compared to what the costs are right now. And then if you start talking memory care on an average facility, you're talking $16,000 to $18,000 a month for one person. It's a tremendous burden. And if you don't have plans in your financial plan for that coverage, it's going to be very challenging and very difficult. So what's out there right now? So you obviously have the individual long-term care coverage, which has issues now because there's not many carriers that do it. Actually, with us working at Securian used to have an individual long-term care contract years and years ago. And like a lot of other carriers, we got out of that market because we just didn't see a profitability within that product. Large number of claims. I know Mike, he has had an affiliation with Genworth, and it's the same thing. It's just there's lots of issues with the design of that product. So the idea of life insurance, being able to use the death benefit early in a life insurance policy, is a great solution. Again, whether it is a rider, which you can see on the right, there's different policy agreements that you can have, and these are specific with Securian. One is just a straight chronic illness benefit. You also have an access benefit that we'll talk about, and also a conversion agreement benefit, which is actually on term. We're one of two companies that actually have that. So you got these riders on individual life policies, but then you have that standalone linked benefit contract with Securian called SecureCare, which is a non-participating whole life insurance contract. But this is one where you really do an asset transfer, and it's a tremendous financial planning tool. I'm going to stop right there. I know a lot of people are on mute. Does anyone have any questions? Okay, we'll move forward. So here's the opportunity. The opportunity is can you work with your clients for alternative individual long-term care solutions? Again, I mean, alternative is not looking at the traditional individual long-term care policy, but utilizing life insurance, especially with the premium opportunities today with the no lapse pricing, locking in insurability, getting a good approval rate from a client standpoint with buying it early to get a good underwriting class. And then the opportunity for an agent that if you are doing their investments and you're doing their life insurance, you're just completing the financial plan by strengthening your relationship with selling a long-term care contract. And it's allowing that cross-selling opportunity to be able to really, again, solidify that financial plan. And we found that from finding these cases, a lot of these cases are coming from people that maybe just have term insurance. They have their investments. They're in their mid-50s and in their 60s. And they're probably going through a situation where there's a family member, whether it's a close family member or whether it's a friend that is going through a long-term care situation, and they want to make sure that that doesn't happen to them. And I actually look at that, and I look at that with myself going through that situation with my mother and father. I've already told my kids they're not going to go through what we're going through, and the financial burden responsibility that we're having to look after my mother and father, that there will be some sort of planning together for that. And it just makes the process so much easier. So we're going to look at different ages here, and then we're going to take some case studies. So let's start with the younger ages, 25 to 40. You might not think of life insurance with long-term care or long-term care planning in this age group. Maybe this is one where they're building net worth, they're building investments. Life insurance is important, especially if they're married and they start having a family. So some of these opportunities, again, are more death benefit protection, getting a reasonable price, and you see a lot of term insurance with this. So some of the product solutions is, again, doing a needs analysis, trying to figure out how much insurance they need. And in a portion of their coverage, could you lock in insurability by having chronic illness coverage underwritten through a life insurance policy, whether it's through permanent coverage or whether it is through a term coverage? So I throw that out with the term. This is something very unique to Securian. So I'm going to actually get out of this presentation, and hopefully we can see this. I'm going to stop sharing, and I'm going to go actually to another page here. So this is specifically at Securian. This is one of the riders that we have called Chronic Illness Conversion Agreement. So this is for ages 16 to 60. And this allows you to put a chronic illness conversion rider on a term policy. It is not expensive. The example I usually give with this, in fact, I do have an example here on a case study. So this is a 40-year-old male preferred $1 million 20-year term. I'm sure everyone on this call, you sell this weekly. This is not an expensive policy. Again, 40-year-old preferred, non-tobacco, and you can see the base premium below, $815 for a base premium. And if I extend a conversion agreement on it, meaning that it's convertible for the full 20 years, it adds $24 to it. So you're not talking that much for your premium. But if I add the chronic illness agreement to this, which basically says, as long as they convert by either the level paying years or age 65, so this is a 40-year-old, so they would need to convert by 60. They can convert to any one of our permanent contracts at the time of conversion and add the chronic illness rider to that policy, where they can access the death benefit dollar for dollar for chronic illness early. Now, if this was a 50-year-old doing a 20-year term, you have to convert it by age 65. So this is not a permanent solution. But I want you to imagine, as an agent, if you had a book of business of this term coverage, you know that as soon as there's a health issue, you're probably going to be converting it. And that's what we are seeing actually with actual conversion results with this product. So Securian sells a lot of term because of this. Us and Guardian are the only ones that have this term conversion opportunity. And from a financial planning standpoint, this is where, on a younger person, you can lock in insurability for chronic illness at a 35-year-old, 40-year-old, young, when they're healthy. You get the best rating class possible. And then this allows you that convertibility option just in case the health is not able to apply for a policy. So whatever policy you're applying for with chronic illness, and it may be you apply for a different type of policy at the time, but knowing that you have this with an approval, with a conversion, I think is a big deal. Now, when people ask me on this rider, it says, well, this isn't a full-blown chronic illness rider on term. This is just a conversion agreement. Well, what if this individual has a stroke and they need long-term care and they're 50 years old? Can you go on claim on the term? The answer is no, but what can you do? You can convert the policy. There's no medical questions on a conversion. It's a 3-page form. So you convert it. There's a 90-day elimination period on our chronic illness rider. So you pay premium on the permanent policy for 90 days or 3 months, and then you are on claim, and we will guarantee to not lapse a chronic illness claim on an individual long-term care policy as long as they're on claim, even if premium payments are not paid. So it is a great way to check the box off of chronic illness long-term care planning off of a financial plan just by using a term policy. I'm going to stop right there. Any questions? So on a 25 to 40-year-old, it could be term, It could also be permanent, right? So if you're doing some sort of combination of term perm, maybe make some permanent coverage with this rider available, so that you could start that earlier, get a good rating class, and lock in a premium. So the younger ages, definitely we are looking at permanent solutions and locking in the coverage and locking in pricing. And as I mentioned before, the no lapse pricing on these products are really good right now, especially if you do a short pay. And with that short pay, you get the best pricing. And that pricing is going to pretty much remain. And I would say all carriers are probably going to remain this year for 2024, but all bets are off with 2025 because of inflation, because of the interest rate market. And also, and one thing to look at down the road is the COVID mortality. There is a lag with COVID mortality. So when COI rates change, you could see also an increase because of COVID. So I'm going to stop sharing. I'm going to actually go back to the presentation. Okay. Navigating through this maze here. Here we go. So next screen is the 41 to 55-year-old. So this is somebody where their kids are, if they have family, kids are older, kids are looking to go into college, hopefully income is higher. So it's a balance of a portfolio of not just term, but trying to find that combination of protection and accumulation focused products. So here, again, it's still the term with the chronic illness agreement, conversion agreement, but it's also these permanent life insurance solutions, especially a no lapse guarantee policy with a chronic illness rider. I would say from a marketplace standpoint, if you were to look at our sales at Securian for the first couple months this year, a majority of our cases are these no lapse policies with a chronic illness rider. And I have a case study for you here. So I'm going to switch over to that. And let's go to the next case study. So this is a case study on Securian's Eclipse Protector IUL. It is a no lapse protection IUL guaranteed to age 120. So we are probably one of the best carriers that want to offer a chronic illness rider with a guarantee considered for lifetime, especially with our low expenses. This is a policy that we are known for. And the chronic illness benefit, and you'll see this not only with ours, but also the linked benefit solution. The chronic illness benefit is indemnity. So it is not a reimbursement. So it's dollar for dollar on this life insurance policy up to the full death benefit, dollar for dollar. If you use it all for a claim, then the policy just ends as a claim. If you use half of it, then the remaining is paid as a death benefit. So the whole idea here is have a permanent life insurance solution. You're guaranteeing, in this particular case, on a 50-year-old female preferred, healthy, that on a $500,000 contract, the $500,000 is going to get paid out one way or another. It's either going to get paid out as chronic illness claim or as death benefit or some combination. So what's interesting about the way this is designed is this is a policy design choices illustration where we on our software can show 3 different scenarios in one illustration. So I like to do that with different there are different designs, especially when you're looking at different premiums. So this is actually a concept scenario of looking at a life pay to a pay to 65 to a one pay and have it all on one page. So on the left is actually the most expensive option the longer you live, even though it's a smaller annual premium at $51.98 to buy $500,000 of death benefit. The longer you live, you got to keep paying the $51.98. And so if we actually have this client live for 30 years, they're going to put $155,000, almost $156,000 into this contract. And if they live past 79, they're going to keep paying. So you got really good cash value, and then you get that permanent guaranteed death benefit of $500,000 with a 4% chronic illness rider, which means up to $20,000 a month, dollar for dollar, off of the $500,000 indemnity. But if we just pay a little bit more, the 84.85, which is a pay to 65 on a no lapse agreement, guaranteed for life, you're already saved the client money at $135,000, almost 136. So just the difference there you can really look at a break even around age 74 or 75, where the client lives past that time period. The client is going to be better off, especially on the short pay. But then I look at that one pay. So if you look at the one pay, 100,000 by the 500,000. Love those scenarios. And we are seeing a lot of short pays and one pays now because the pricing is so good. You think about 100,000 buys 5 times the leverage, guaranteed. So you can imagine what the IRR is on this case. Plus you have the 4% monthly rider on the chronic illness. So that 99,946, if they just paid that, that's a mech, which a lot of people look at that and say, well, is a mech bad? Well, if it's paid for death benefit or chronic illness, doesn't matter on a mech. The mech only comes into play if you start accessing the cash value. In these particular cases, you're not accessing cash value. You're accessing death benefit and chronic illness. So this could be, again, person writing check, making a mech. It could be a 1035 exchange, which we are seeing a lot of opportunities of clients who have whole life policies that want to maybe end premium payments, but they need chronic illness as well. If they're still relatively healthy at a good age, we can look at rolling that cash value over to a policy like this, buying as much guaranteed death benefit as possible, putting that 2 or 4% monthly rider on the death benefit, and then having a contract where we could do a limited pay so that when they're in retirement, they're not paying life insurance premium. I'm going to stop right there. Any questions? Now, from an underwriting standpoint, so just quick underwriting update. A lot of these policies, again, you could either choose full underwriting or accelerated underwriting. We do offer these policies, whether it's term or permanent, with chronic illness through accelerated underwriting. So ages 18 to 50 up to 3 million, we can issue a policy without exams, without APSs. Ages 51 to 60, it's up to 1 million. So this particular client, age 50 healthy, could very well be approved quickly with an e-application and accelerated underwriting because it's within those thresholds. Now, if we go into full underwriting, I think, again, we're very competitive from that standpoint, especially if you look at controlled medical conditions, controlled blood pressure, controlled cholesterol. If they have sleep apnea, if it's controlled using a CPAP machine, we're actually very good ratings on that. Controlled A1C, we're also very good. Just depends on medical records and it depends on the history of control. I'll also throw out some of the niches that we also have just from an occupation standpoint. Aviation, we're actually a known carrier for pilots, especially if they're AFR rated. And professionals, police, firemen, municipalities, we're also very good. Any questions? Okay, I'm going to go back to the PowerPoint here. And I'm going to bring it on and introduce Mike Swayze. He is our RVP for Securian, our linked benefit contract. Let me get this up here. And he is going to review the older ages 56 and above, and the opportunity for that.
All right. Thanks, Rob. And certainly thanks, Lewis, and everyone on the line for joining us today. So in continuing with the theme from a life stage perspective, age 56 plus, when we're looking at that from a long-term care planning type of mentality, pay less attention to the age and more attention to the goal that the client has in mind, right? So the product I represent, we can actually write as low as 40, as old as 75. That doesn't mean we write a lot of 40 and or 75-year-olds. We don't write many in their 40s. They have other priorities, right? Death benefit is a focus. Retirement planning is a focus. It's not really until those kids tend to get off the payroll, get out of the house, that long-term care planning. Long-term care planning is usually a trigger type of planning. Rob mentioned his own personal situation with his parents. And then he also mentioned his kind of desire to plan for his own kids. That's what I mean when I say trigger planning, right? So make sure you're talking with your clients about what's happening in their life. How are their parents? How are their grandparents, depending on their age? What's going on? And those triggers can certainly help mold that conversation. But when we get to someone that is focused more on a long-term care planning, Securian is certainly a great option. We do a lot of 1035 exchanges into Securian in terms of lump sums, as well as a lump sum with ongoing annual premiums. But really what Securian is all about is about providing leverage for the future. So we tend to have a long horizon when it looks at putting a policy in force. The average issue age is roughly age 60. When the average claim age, those claims don't spike into tend to be early to mid 80s. So for a 60-year-old, it may be 25 years before they need to use this policy. So a couple of things come to mind, right? Inflation is very important in my world. And also making sure that the client understands the policy and giving them a policy, giving them choices that are very easy to understand, that are fully guaranteed, and with what I call no trap doors. We don't want clients to get to that 25-year or maybe even longer time horizon in the future. They need to go on claim. Quite frankly, it's a higher probability there's going to be very few people attached to the policy when they bought it 25 plus years later. So we want to make sure that it's going to work exactly how it's supposed to work. SecuriCare does a great job of that. Fully guaranteed cash indemnity plan. So I'm going to walk through two case studies. Gotcha. Definitely two people trying to learn how to do a screen share off of a foreign computer. Almost there. There we go. Okay. So the first case study that I like to do is anytime insurance companies tend to show examples, it tends to be large dollar examples, right? $100,000 single pay, $10,000 a year, 10 pay. Those are the most common that we see. Unfortunately, that's not always the reality. We do a lot of that business, but I always like to show something that's a little bit smaller, that still provides a lot of power, a lot of leverage for clients. So what we're looking at here is a 56-year-old female, so just matching that age that we talked about earlier. This is a non-tobacco with couples discount. So this premium over a 10-year period of time is just over $4,000 a year. We can pay this monthly. There's no modal factor on SecuriCare, so it's just the annual premium divided by 12. So that's going to give us an annual premium of just under $340 per month. Okay, so for many, very affordable. It's probably half of what their lowest car payment is. They probably spend that eating out, but nonetheless, very affordable premiums for many. And how we structure this is our very basic structure. We put it over a 6-year benefit period with 3% compound inflation. What that's going to do is give the client a day one monthly LTC benefit of $2,083. Now, this structure, that $2,083 is the smallest monthly benefit we will have. So this is what I call a minimally funded account. But that monthly benefit over that 6-year period on day one is equal to just over $161,000 in total benefits, right? So we turned $40,643 in total premium to $161 right out of the gate. But the good news is they're not using this day one, right? Hopefully they're not using it day two. Hopefully they're using it year 20, year 25 and beyond. So if we look forward at age 85, this client would have a monthly benefit of just under $5,000 a month with a total long-term care pool of $381,000 over that 6-year period. Now, what I say to everyone is it's not important. As Rob was going through some of the costs up in the North Carolina area, those are legitimate, real costs, and it's a real concern, right? Don't think that we have to show a client to cover 100% of those costs. It's very, very important for clients to kind of, the easiest way to eat the elephant is small bites at a time, right? So $5,000 a month is going to take that and protect those assets. Essentially what we're doing with this one example is protecting $381,000 of assets that they don't have to sell. They don't have to turn into a taxable situation. We're going to give them this income stream. The only difference between this and a retirement income stream is the medical trigger, and this comes out tax-free. So when we look at SecuriCare, we always like to look at leverage, and you heard Rob mention an IRR, an internal rate of return. So when we look at leverage, this $40,000 premium over that 10-year period is providing over 9 times leverage for that $381,000. That's super powerful, right? If clients aren't interested in leverage and they're more analytical, they want to see it more in terms of internal rate of return. If you're competing against a CD at a bank, if you're competing against a fixed non-qualified annuity, for example, that they may be interested in, great. The IRR on this at age 85 is 8.4%. Now, what that means is if we took this exact same premium, that 10-year spread of $40,000 total, and put that into an investment, we would have to earn a rate of return of 8.4% after tax. That is going to be hard to do in a guaranteed type of situation where money's coming back out tax-free. Their CD won't touch it, their fixed annuity won't touch it. It's a great solution for those clients that know we need to plan. We may not have the big lump sum to dump in. We may not have that larger 1035, but guess what? Like I said, the best way to eat the elephant is to begin little bites at a time. And this 56-year-old client, who knows, they could get 5 years down the road. Maybe now they've had an inheritance, want to do a single pay dump in. They can certainly set up another policy and continue this type of planning. The second that I'd like to show is for a slightly older client. This is a 62-year-old female. Now, as I just said, insurance companies love to show the big numbers, 100,000. So I'm breaking my own kind of rule here. We're showing a large number, but the reason I show 100,000 is we can easily divide this by 2. We can take 3/4. We can take, a third of this. It's easy math to do. So if we use 100,000, let's say this may be a 1035. This could be money sitting in a CD account. One of the easiest ways to uncover these types of assets is to simply ask your clients, as you're having kind of that long-term care planning conversation, ask your clients if they needed care tomorrow. They had to come up with $5,000, $10,000, $15,000 tomorrow to pay for their care. Where would that come from? Where would be the first asset, their first check they wrote? Where would that be? How would they get those assets? If it helps to uncover those CD dollars, maybe they're planning for care for that. Great, we can target a portion of those assets and do a simple asset transfer, right? But this client, slightly older, same female, non-tobacco couples discount, very similar story, right? 6-year benefit period. By the way, we're seeing a lot of females go all the way up to our max duration, which is an 8-year benefit period. So for those women that have longer longevity concerns, maybe they had family history of dementias and other cognitive impairments, where they tend to survive a lot longer while needing help, that 7- and 8-year benefit period is great. If we're working with some men, great, we can go as low as 4 years. We can front load this a little bit more, give them a higher monthly benefit in exchange. That total pool will obviously be a little bit lower. But when we look at this situation here, this day one monthly benefit, quite a bit higher, $5,200. But that age 85 benefit, we don't have quite as long for it to grow, but that single pay lump sum going in is a dramatic help, right? So a monthly benefit of $10,277. That's going to be just about 8 times leverage when we look at that total premium compared to the total benefit of $797,000. And that's an internal rate of return of 8.34%, right? So again, can the client in the current investments or lazy money is where we tend to find these, are they earning something that's going to get them guaranteed 8.34% after tax? I can guarantee that answer is going to be no. In addition, it's going to come with death benefit, tax-free death benefit, residual death benefit. There is no way the client does not get their full benefit, their full premium out of this policy in one way, shape, or form. All right. So it's a very, very simple, very streamlined process. And again, the whole product is fully guaranteed. It's a cash indemnity benefit. There's always big conversations in my world between cash indemnity and reimbursement. I don't like to poke holes in anyone's plan. Any plan is a better plan than no plan. Where it comes to me, when I talk about the difference between cash indemnity and reimbursement, it's really quite simple. Cash indemnity, we do not eliminate any caregivers today. We can eliminate them tomorrow, meaning we, as in the family, they can say, no, I don't want my family members providing care. Great. I don't think you should. I don't think that's fair to family members. But if you're thrown into a situation where you may have to be on a waiting list for a facility, can't find the proper home care service to help with the needs, family member may be thrown into a forced care situation, at least we are able to get those benefits out to you and help pay those individuals for their time. And it also is the only way that we can maximize the leverage that we show. Every single month, we know the client's going to get, in this example, $10,277. And every single year, they're going to get a raise because of that 3% compound inflation. All right. So we're going to go back to this one. No, thank you. back to the presentation. There we go. All right. All right. So basically what Rob and I talked about is depending on the age, the client may be experiencing different things, right? So those younger ages, 25 to 40 years old, it's all about preserving insurability, whether it's insurability for LTC and chronic illness, insurability for death benefit, making sure families protected long-term, do that earlier. And it's a heck of a lot cheaper when you start early. Those mid-age, that 41 to 55, really depends on where's that focus, right? Are they more concerned about death benefit? Are they more concerned about long-term care? Whether it's term options, permanent options, we have some great solutions here. And then with those older individuals, again, Secure Care really comes in with those, I'd say 50 plus. Either way, make sure you work with Lewis. We've got you covered no matter which way you want to slice it or dice it. And Lewis can certainly, if there's situations that Securian is not the fit, Lewis will tell you. We'll also tell Lewis, hey, this is not the right fit for us. We want you to place the case. Look at us first, but then if we can't help, certainly let's get it placed. So with that being said, I'm going to kick it back to Rob to talk through a way to get kind of down to the bare bones with some help in finding these clients during reviews.
Okay, thanks, Mike. So I am going to actually share another screen here. And this is where we're going to get to part of the presentation of where do we find these cases, right? So it's great from a product standpoint, and you might love the product, whether it's linked benefit or the individual policy with the rider, but how do we find them? So I provided Lewis with all of this material, so you will get it, including this piece right here. This is one of my favorite marketing pieces of Securian right now. So Securian, we have a lot of marketing campaigns, but one of the marketing campaigns that we're kicking off for this year is life insurance reviews. And if you've ever done one, obviously, or especially using it from a prospecting standpoint, you know that if you work with a new client and you ask them about their life insurance and you ask the question, when was the last time somebody's reviewed their life insurance policy? Usually people will say that it was the day they bought it, and they've not seen the agent since then. And this is where this form helps out a lot. We have a great review kit at Securian. It's 20 pages long, or the original was 20 pages long. It's really thorough. It's very comprehensive. But what we found was agents wanted something simple and straightforward. So we created a one-page back and front life insurance summary fact finder that you could record the permanent coverage that they have, the term coverage, and ask some very pertinent questions, especially about living benefits, long-term care and chronic illness coverage, that really uncovers and finds cases. I've always found with some of the opportunities here that some of the best cases are sitting in your file drawers and you just don't realize it, especially if all they have is term insurance. So if you look at some of the points on this form, which this form on the electronic version, it is fillable, and it's actually got a link on the back I'll show you here that goes right to a life insurance calculator. So on the permanent coverage, you know, the insured, the company, type of coverage, premium, surrender value, death benefit, very basic stuff. But as you know, when you review permanent coverage, the only way to see the health of a in-force contract is to do an in-force illustration. Because a lot of times if they missed a premium, you don't know that. If it's the first time you're looking at the case, you need to see, especially if there's a no-lapse guarantee, how long the guarantee goes on this policy. And we have seen so many rescue opportunities where that in-force comes in, and the original illustration says the policy is going to go to age 120, but on the in-force illustration, we find that it goes to the mid-80s, and that really doesn't meet the client's needs at the particular time. Also, what agreements are on these policies, especially is there long-term care options on there, and is it something that they're interested in? Now, on term coverage, again, same information, except we add years remaining in the term, which no client knows. They look at term as a commodity. They look at it as a price. They have no clue usually they're in the 15th year of a 20-year term policy. It would be really nice to know when that ending date is and if there's a conversion period to it. I actually ran into a case last week. Somebody called on a Securian term contract. They had it for a while and they wanted to convert it, but I had to reach out to them and tell them that they missed the conversion period. And it happens all the time because they don't know the information on this. They think it's like auto insurance, that they pay a premium and they have coverage. So you look at the priorities for review, whether it's lower premium, longer guarantees, maybe they're focused on cash value, guaranteed death benefit, or it's those additional living benefits. That's the long-term care and chronic illness. And this is where I would use this form as a kickoff for the information that you learned today. Talk to your client about what they're doing with long-term care planning and whether or not they should use their life insurance as part of their planning. Now, on the back of this form, this is where I think there's a real value of this form. So look at the questions. And I say this with a lot of advisors. A lot of advisors don't go deep into this. And if you do from a life policy review, you'll find so many opportunities. So again, when was the last time you evaluated your life insurance needs? What was the purpose of the life insurance coverage when you initially purchased it? And has the goals changed on these policies? And it may be something where you need to work with Lewis to refit this policy in the current financial plan and do some changes, whether again it's replacing it or whether it's keeping what they have and having a life insurance expert actually go through it to say this is what you need to do. Do you intend to use the coverage for living benefits as well as a death benefit? What are the beneficiary designations and do they need to be changed? Now, on the right side, it's determining the amount of coverage. Again, whether it's covering outstanding debt, whether it's covering any life-changing events, leaving a legacy. Value of this form is you see the QR code here, and then this blue link for securian.com/life calculator. If you go into that link, it goes into a calculator that there's a detailed version and a quick version that once you complete it, you could get a life need calculated in about 60 seconds. It's really quick. And you could actually make it as a PDF copy and actually have it emailed to your client. So great resource, but it's also a resource that I think you can quickly determine needs and quickly uncover needs. And what I know Lewis and working with him on this form, if you could fill this form out and then send it over to Lewis, Lewis could then work on the needs analysis and work on doing an evaluation of their current life insurance policies. And so then as a team come together to determine what is the best fit for the client and what is the best portfolio arrangement for life insurance. Again, whether it's using chronic illness long-term care solutions or if it's just death benefit focused. Any questions? Okay, that is the end of our presentation. I really appreciate everyone hanging on with us. If you have any questions, please let us know. All of the material we discussed today, Lewis has, and he will send it over to you guys. And if you have any questions on cases, let us know. If you would like to set up a Teams or a Zoom meeting to discuss some of these ideas or concepts further, we are definitely available, and we're also available for a case consultation as well. With that, I'll pass it over to Lewis. Thank you.
Thank you very, very much. Definitely appreciate Rob and Mike coming by today. Thank you very, very much. Just a couple of quick points. I want to open it up for questions one last time. That's number one. If we have any questions, you can unmute yourself, ask away. We're here to try to help as much as we possibly can. But before I let everyone go, I just want a couple things I wanted to touch on. Some things we didn't touch on were, and I think it's important for you guys, for the advisors, what kind of company is Securian? Been working with Securian for a while now, and I can honestly tell you, Rob, Daniel, Mike Swayze, from my interaction with them, are top-notch individuals that you want to have on your side. We've had several cases. Most recently, we've had a couple where Rob has to intervene and help get done. And if you have partners that you're working with, that, in my opinion, what I like to offer you guys is solutions, ideas, and case designs to take your business from here to here. And that's our whole point. That's my whole goal for this year, is to help as many advisors increase their business. And when you have partners like Securian, Mike, and Rob with you, there's no way that can't happen. So you have a very top-notch, highly rated, great products, great solutions. And it's something that I think if you have, look, they're not the end all be all, but if you have them in your quiver, then you've got something. And whatever we can do to help, we definitely will do it. Once again, I want to thank everyone for joining us today. Rob, Mike, thanks for being here live. That was a pleasure. I hope I didn't scare you with my clap, but I had to wake myself up. It's been a crazy morning today. Once again. So thank you, everyone. If you have any questions, I'm sure I will reach out to everyone here at some point in the coming weeks. Please bear with us. We got a ton of agents, and I see a ton of agents here that I recognize their names and some that I do not. Those that I do not recognize your name, welcome to Best Agency. I will guarantee you one thing. You work with us, you're going to see a huge difference in your business. With that said, we're going to end today's session. 2:47. We're a little long, but once again, thank you very much for joining us. We appreciate it, and we'll talk soon.